Options. Well, we're not talking about choosing between an apple or a banana. Everyone knows bananas are better. But we're actually talking about options in the market. Options are not only in the stock market, but they're also in crypto as well. Using options is a great way to have insurance on any of your positions. So if you guys are making a YOLO bet on Bitcoin or Ethereum and you're throwing everything at it and you have no hedge or insurance to the downside, what would happen if everything goes against you? Do you just lose everything? Well, with options, you can actually hedge your position, have insurance, and if it goes to the downside, you can actually break even or sometimes even make more money. In today's video, I'm going to explain what options are, how they work. I'm going to demo options on a platform and give you examples to show you how you can use them in the markets. Before we dive into options, you need to understand how stocks work. So let's go ahead and explain stocks. Tony's got some nice Jordans, and he knows someone's going to want his Jordans. He believes he can easily sell it for 150 bucks. Freddie sees those Jordans and he's like, man, those are pretty valuable. I'm pretty sure I can sell those for $300 in a month. I'm going to go ahead and buy them. So Freddie buys them for $150. A month later, he goes and sells the new Jordans for 300 bucks and he pockets the 150. This is how the stock market works. Buy low, sell high. So let's summarize where we're at so far. With stonks, we spent $150 on these Jordans. We're at $150. It goes up, it goes down, I'm out. So I have all the risk to the downside and I have all the risk to the upside. Now this is how options work. Let's say, for example, I don't have the $150. I just got $50 and I don't want to be out $150. And I'm like, Tony, bro, let me slide you a fast one. I'll give you $50. Just hold the shoes for me. And whenever I ask for it, you'll sell it to me for $150 within the next month. At this point, I'm basically locking up the price by putting down that $50. You can consider this the deposit. So now here's where we're at with the options. Remember, back with the stocks, we paid $150 for the Jordans because we're thinking in a month or 2 months, I'm going to be able to sell it for $300. So I'm going to pocket the $150. So I spend $150 for my Jordans. But now with the options, I think these Jordans are going to $300 in 2 months. I know it for sure. So I tell buddy Freddie, hey, I only want to spend $150 and I want to lock up an option with you. I'll pay you $50 for that option. So I'm out $50 because I paid for that option. And at any time between the 2 months, because that's the agreement we make, I say, hey, at any time between the 2 month period, I can say, hey, I want to go ahead and exercise my option and buy my Jordans at $150 because now they're selling at 300 bucks. I want to go ahead and exercise, get my Jordans for 150 and sell them for 300. I profit $100 because I'm out 150 plus the 50, but I'll explain that later in this video. So the setup right now is I spend $50, I get this option for 150. So stonks, I spend 150. Options, I only spend 50. Now, of course, that's not all. This is just the general understanding. So now's my chance. The NBA Finals are in town and a bunch of ballers are wanting some Jordans. So I'm like, bro, I got some J's. They're worth $300 if you want to buy some. I locked up $50 with Tony, so I know he's holding them for me. So I find a guy, I got him. He's willing to pay $300 and I make the deal with him. I get $300 from the baller and then I pay $150 plus interest to Tony. I get my J's from him. I give them to the baller and now I just pocket the rest. So I basically just made $100. Why is that? Well, this is how you factor it in. I gave him $50. I gave him $150. I basically invested $200. The $50 was the cost of the option. But here's the cool part. Those shoes that were worth $150, let's say they went down to $20 after I put down this $50 deposit. Well, at the end of that month, Tony can come to me and say, bro, time's up. Time to buy your shoes for 150 bucks. I'm like, bro, these are worth 20 bucks. You keep your $50 and get out of my face. I only lost $50 in that option. Whereas if I bought the shoes, I would have lost $130 because 150 minus 20, that means I would have lost $130. But the option protected my downside because my lowest downside was $50. But my upside was uncapped. Let's say, for example, I found someone to buy those shoes for $1,000. Well, I would only be out the $150 to buy them from Tony and then my $50 option. That's how options work. With a better understanding of options, let's go and go over a couple of vocab terms you guys will need in order to understand LIRA finance better. The first is a call option. The call option is the right but not the obligation to buy an asset at a specified price before a specified expiry date. So this means you have the option. You are not required to buy that asset when it becomes expired. The second is a put option. This is the right but not the obligation to sell an asset at a certain price before a certain date. Remember, these are options. So a call and a put option, they are not requiring you to buy it after those dates expire. So if my option is up in a month, I'm not required to buy that. I can just let my deposit expire and that's it. The next is the strike price. This is the price which the put or the call option can be exercised. So if my strike price is $1,900 on ETH and ETH is trading at $2,000, well, I can exercise my strike price and get it at $1,900 if I wanted to. The contract expiry is the date that the contract expires. So if my contract date is August 31st, 2022, then that means, okay, my contract expires on August 31st. The option premium is the cost of the option contract. The premiums differ based on how close the option is to the actual price on the market. So if ETH is trading at 1900 and I have an option at 1800, that premium is going to trade for more because if I exercise my call option when it comes to the expiration date, well, I get it for $100 less. And the opposite is true. If ETH is trading at $1,900 and my call option is with ETH at a price of $2,500, the premium is going to be much less because it's not even close to the current market price. So let's go ahead and show you guys how this would look on an options platform. I'm going to be using LIRA Finance for this example. I just bought 10 ETH. 10 ETH cost me $18,879. Let's just call it $19,000 just for even numbers. I'm basically out $19,000. Now, of course, I still have the 10 Ethereum. This is awesome. But if Ethereum goes to zero, I have no money. I just have 10 ETH. But if Ethereum doubles, well, instead of having $19,000, I now have $38,000. But I bet a little bit too much, and I want to hedge my position. This is where a options platform would come into play. I would need to purchase a put. Let me go ahead and show you how this would look. The Ethereum I bought, we're just going to call it, I paid at $1,900 a pop, and I bought 10 of them. So I'm going to go ahead and buy insurance for my position for the next 2 months. I'm going to select October 28th at 4 a.m. And I'm going to go ahead and buy a couple of puts. Remember, the put is the right but not the obligation to sell a certain asset at a specified price upon the expiry date, which is October 28th. So I need to go ahead and hedge my position. I'm going to look for a sell price of around $1,900. Well, the closest one they have is either $2,000 or $1,600. Because I'm cheap, I'm going to select the one that's $1,600 because I'll only have to pay $226 per option, whereas this one is going to cost me $465. This mainly has to do with the current cost of Ethereum and the sell price. Remember, the put options is basically saying, hey, in the future, I'll be able to sell ETH at $2,000. You're paying for this premium because ETH is only $1,879. So if I wanted to sell at $2,000, which is $121 over asking price, I can pay a premium for it. So I'm going to go under asking price. Sure, I may lose a little here and there, but I'm going to go ahead and purchase some options from this to hedge my position. So this is going to cost me $2,200 to hedge my position. So let's break down where we're at so far. I spent 10 ETH at $1,900 a pop. So this is scenario one. I'm out $19,000 because I bought 10 ETH. So scenario one, I'm out $19,000. Now, the next situation is going to be the hedging situation, which I spent 10 ETH, which cost me $19,000, and then the $2,288 for insurance. This is going to be for the option. So I spent $19,000 plus $2,288, and it's a total cost of $21,288. Let me go ahead and summarize this again. Option one, it's just buying straight up ETH. This is $19,000. Option 2 is straight up buying ETH with a hedge. So this is going to cost me $21,288. Let's go and give you scenario 1. ETH goes to 1K. It's currently at 19K based on these prices. Scenario 1 is my 10 ETH that was worth $19,000 is now worth $10,000. Because if you do 10 times 1,000, that gives you $10,000. So I'm down 9K on my investment. Scenario 2 is if we bought the insurance. So my 10 ETH is now worth 10K. Why is that? 10 ETH times 1,000 is $10,000. So 10 times 1. But I also had the option 2, which I paid $2,288 for. So with my option, I was able to sell ETH at $1,600 because I bought a put option. A put is the right but not the obligation to sell an asset by a certain date at a certain price. My certain date was October 28th. My certain price was $1,600. So we can see here, since I bought 10 of the options, I could sell 10 ETH for 16K. So I would take the 16K that I can get for the ETH minus the 10K, because that's the actual market price. If I would have just bought it, that would be a $6,000 difference. So in theory, my profit is $6,000. But I need to subtract my insurance premium, which is $2,288. My total profit is $3,712, just for kicks. Let me sum it up again. 10 ETH times $1,000, 10K. I'm down $9,000. But I had the option. The option netted me a $3,712 profit. This is minusing the fees and minusing the actual market rate. So instead of being down almost 50%, I'm only down about 25%. So this is how you can factor in hedging your position. Now let's give you the other scenario. ETH goes to $2,500. So my 10 ETH is now worth $25,000 because you do 2,500 times 10, you get 25,000. My profit is 6K. I'm in the green. This is awesome. Now the second scenario, I still bought my insurance. So I'm like, this stinks. I have the option to sell ETH at $1,600 when it's selling $2,500. Forget this junk. So my 10 ETH times 2,500 is now worth $25,000. I'm happy. But I need to minus the $2,288 from that because I'm not exercising that option. That's trash. Why would I sell ETH at $1,600 when I can clearly sell it for $2,500? I'm letting that thing expire. So my insurance, go ahead and take the money. I don't want the $2,288. So at the end of the day, I'm at $22,712 for my net balance. Now, of course, this is not my profit. My profit is $3,712. So now you can kind of see the value that options can bring, especially if you're uber bullish on the market. I bought a bunch of ETH, but I need to hedge my position, and you can buy puts in order to hedge your position. Also, if you're bullish on the market and you don't want to throw up a bunch of upfront capital, well, you can do this by buying different calls. And these get more expensive the lower the price of the call. The reason for this is if you have a call at $1,200 on ETH and ETH is trading at $1,879, that means, well, you can buy ETH almost $700 under the market price. Hence why the premium is $767. Now, if all of this sounds like jargon for you, I really like Lyra Finance because they allow this. If you're buying this option and it expires on October 28th, this will show your expected profit and loss. So if I bought it today, I would be at a loss of $4 because there's fees involved in that. However, if ETH then zooms up to $2,400, I would make $400 on this option. And that's even after subtracting the fees. Now, of course, if I had the upfront capital, I would make more money if I straight up just bought the ETH and sold it, but it wouldn't be that significant of a difference. In fact, 1 ETH compared to a 1 ETH call, it would be about a $50 to $100 difference because of the fees as well as the time frame of the expiration. So options are basically allowing you to use them as a hedge against your position and have insurance, or it allows you to take a position to go long or short without having to risk a bunch of upfront capital. So I hope you guys enjoyed this video, and I hope this helped understand options a little bit better and how you can use them to your advantage to hedge your positions in the market, as well as protecting against volatility. I'll be making some more videos explaining Lyra Finance or other options platforms and how you can use them to your advantage. And options, in my opinion, are going to be a way where platforms migrate to have a sustainable yield. And the reason for this is because it's people buying insurance and it's costing them money to do that. Just like when you buy life insurance, every year that you don't die, well, you're just wasting money. So just something to keep in mind. Let's go ahead and hit you guys with a wisdom one-liner. Proverbs chapter 12, verses 18. The words of the reckless pierce like swords, but the tongue of the wise bring healing. Be good, be nice, think before you say. Thanks for tuning in, guys. Hope you guys enjoyed this video. Make sure you guys smash up the like, subscribe to the channel, hit that bell notification. That way you guys are notified every time we make a new one. If you want to go ahead and join the Discord, links in the description below. We'll see you guys in the next one.